Well, it's great to see everyone here, and amazingly, virtually everybody who signed up is here. And that must be partially because of my threats about choking you if you didn't. So the good news is you won't get choked today if you're here. So thank you for being here. We did a program similar to this a little over 2 years ago, April of 2017, so it's probably time to reinvigorate all of you and reintroduce you to all of the Coldwell Banker commercial programs. So as you guys know, we've been a part of Coldwell Banker since 1986. And as part of that, Coldwell Banker Commercial, which is a separate brand under Coldwell Banker, which has existed, actually Coldwell Banker was founded as a commercial real estate company in San Francisco in 1906. Coldwell Banker, when they were owned by Sears, they sold the commercial division, and that company is now known as CB Richard Ellis, which is, CB stands for Coldwell Banker, one of the largest commercial real estate firms in North America. So Coldwell Banker was under a non-compete agreement with CB Richard Ellis for many years, and then reopened the commercial division. We are the commercial affiliate for the Florida Keys, so we are a franchisee, and we specifically have all the marks and names and brands for Coldwell Banker Commercial, which all inure to your guys' benefit when you're working with commercial buyers and sellers. So want to thank everyone who helped to set this event up today, including Brenda. Thank you, Brenda, for organizing all this, and Nicole. Thank you, Ruth, for organizing the speakers and making sure that everything went well as well. This is being videotaped. Cliff is in the back, so any of you guys that want to refer back to this, you'll have that ability later on. We do have, as you know, you guys have seen your agenda, we do have some great speakers and resources for you. And I want to talk to you a little bit about what the purpose of this is today. Well, this isn't meant to be an exhaustive seminar on commercial real estate, because we couldn't do that in a day, probably couldn't do it in a month. What I want to make sure is that you guys understand the resources that are available to you, including Coldwell Banker Commercial. Lynn is going to talk to you. Lynn Conrad, our ambassador for Coldwell Banker Commercial, is going to be here to talk to you about all the systems and programs that are available to you through Coldwell Banker Commercial. Hopefully you'll all leave here being able to connect with Coldwell Banker Commercial and access all of that information. Number two, I want to make sure that you know that the other speakers that are here today are also resources for you as well. So Mike Touchton is going to be up. Mike is he actually has an office in our Key Largo office. And, Mike does, I would say, a majority of the commercial appraisals in the Upper Keys. He's very knowledgeable. You can always talk to him. I always get a lot of information from him, and he likewise gets a lot of information from us. So if you are looking at a motel or a business of some sort or commercial property, he will be happy to share with you typically his spreadsheets for all the comparables. He can't give you those appraisals, but he can give you some of the data. So you need to understand that resource is available to you. Tom Wright, who is one of our corporate attorneys, along with Mike Halprin, is also going to be here today to talk to you about the commercial contract. And Tom, as I hope you all know, is a resource that's available to you. All you have to do is pick up the phone and call him and talk to him, and he can walk you through any of the issues related to your transactions, whether they be residential or commercial. Best to certainly talk to Ruth or I probably before to see whether we can address your issue, but if you can't, Tom is always available to you, and I know many of you reach out to Tom on a regular basis. Jeff Smith is also a great resource. I've known Jeff since he worked at First National Bank of the Florida Keys, He's now senior lender at First State Bank of the Florida Keys, and he's a great resource for you for commercial lending. And you can always reach out to him, and he's always been very helpful to me, and I'm sure he will be to you. So I hope you guys will remember to turn off your cell phones. Wanda, where are you? Oh, great, thank you. That ring makes my blood pressure go up like 20 points. I'm sure it does the same to you. Could revive you if you ever, you ever had a heart attack or something. I'm sure it would work to get you going again. So, want to talk to you today about what the purpose is. So we're not going to have an exhaustive discussion about commercial real estate. We're going to try and make you guys feel more comfortable about talking to buyers and sellers about commercial real estate in the Florida Keys. That's all we really need to know, right? We need to know about residential and commercial real estate in the Florida Keys. So it is not as complicated an issue as some of you may believe it is. There are a number of you in this room who regularly do commercial transactions and who've done some large ones. Sean just did a nice one in Key West. Paul just put one under contract. Josh has got a couple under contract, as well as Sam. Sally, who's not here, does some commercial deals, and I'm sure there's other of you in the room who do them. Jimmy too, in Big Pine. So the thing I would like to have most as a result of this is A, that you guys first understand all the resources that are available to you through our company, and B, that you generate some level of comfort about being able to venture into the area of commercial real estate. It's virtually no different in the Keys. You're going to hear people talk about terms that you may have heard and you may not understand, like EBITDA and cap rates and all this kind of stuff. Largely, they don't apply here. You need to understand what they mean, but in terms of applying them, in evaluating properties, it's not likely going to be something that you're going to have to deal with directly. Most of the buyers and sellers that we deal with are owner-occupied users. They're not investors. They're not looking at properties based on internal rates of return or any of the kind of investment formulas that you're going to learn about if you went through a CCIM program. So with that, what I want to do here is just introduce you to some of these concepts that you're going to hear today, show you what's available to you in terms of what forms and presentations are available to you in IQ Office and dotloop in terms of the things that you have. There's a full commercial presentation available to you online that you guys can use to develop a listing presentation or a buyer presentation for any of the properties that you have. Google Earth is a great way to be able to show people where these properties are in relation to one another. You guys should get your arms around how to use that. We're going to talk at the end of the day about some of the specific commercial marketing opportunities that you have through Coldwell Banker Commercial and LoopNet and CoStar, which are commercial-only websites that are used significantly by commercial agents. So this is meant to be a collaborative event here, guys. So I would appreciate, especially any of you who are involved in commercial transactions, to ask questions, speak up. If you don't understand something, we're all here to learn today together about how we can do more real estate deals. My job is to help you guys make more money. So if you can feel more comfortable about talking to buyers and sellers about commercial real estate, my belief is that all of you can make more money, because I know some of you shy away from those deals because you're just not familiar with the language, or you have some reticence, and I would encourage every one of you to get involved in any commercial deal opportunity that you have in front of you, and I'll help you, Ruth will help you, the other resources that we're going to talk to today that are going to talk to you, including Tom and Jeff and Mike. They'd be happy to help you as well. So with that, we'll look at a few slides. Anybody have any questions about anything that we've talked about so far today? So I'm just going to talk to you about some basic commercial real estate terms, calculations, none of which, and so all of this is in your books. So thank you, Brenda and Nicole, for putting these books together. Everything that you're going to see today on the screen is in that book. So you've already got it. You're welcome to make notes. I would encourage you to do that. I would encourage you to ask questions. Just raise your hand, stand up in your seat, whatever you need to do to get my attention, and we'll try and make sure that you guys get the most out of today that you possibly can. So again, really the only thing that you guys need to get out of today is a little confidence, is a little bit of understanding that there's nothing significantly different about commercial real estate than residential real estate. There's a few different terms. That's about it. As you all know, there's a few people in the Keys who specialize in commercial real estate up and down the Keys. You can probably name them. A guy like Curtis Scomp, for instance, who worked with us for 18 years. I can tell you, Curtis doesn't know a hell of a lot more than anybody in this room about commercial real estate. So you don't need to feel like there's some magic pill that he took or some knowledge that he has that you don't have. It is not the case. The only difference between you and him is that he's comfortable working in this area and you may not be. So basic stuff, gross income. We all know what gross income is for a commercial real estate property, right? About operating expenses. And so I won't go through these with you but operating expenses are all the expenses that would inure to a property to make it run. So they typically don't include income taxes and mortgage payments. That's operating expenses, operating the property or the business. And we'll talk a little bit about the difference between valuation of commercial property and business valuation, and they're totally different concepts. A lot of people think that somehow you value the real estate and then you value the business and you add them up and that's the value of the property. The problem is that the business can't operate without the real estate, so you can't add them up. They don't just add up, and that becomes the value. So there's operating income, which is the difference between gross income and operating expenses, and then you can break it down into net operating income, which is the bottom line after debt service, taxes, and depreciation. And you guys know that there are cash expenses and non-cash expenses associated with commercial real estate. Right? Depreciation is a non-cash expense. It's obviously an important part of commercial real estate in terms of understanding the tax consequences, but it's not a cash expense. Cap rates, you guys hear a lot about cap rates. It's just one of the investment formulas that exists that just determines the rate of return that a buyer is going to get based on the value or the sale price of the property. So it's just net operating income divided by the current price or the market value of the property. You can determine it based on whether you're buying it or whether you're selling it. So it's a very simple formula. The problem is getting net operating income. That is not a figure that's readily available to most of you. Most sellers honestly don't know what the hell their net operating income is, and most of them try and hide it. Most people in business who operate real estate are trying to shelter income, not show it all. So one of the challenges that you're going to have is that if you get involved in a commercial real estate transaction, you're going to oftentimes have to recast the income and recast the expenses. So you got to recast the income to show all of the income and recast the expenses to pull out the expenses that are personal expenses that every owner of a commercial property they're going to pay their own Health insurance, typically through that, they're going to pay lots of their travel and personal expenses through their business, because that's one of the advantages of owning a business, right? So while it's a very simple formula, it's very hard to get to in terms of, and Mike will talk about this a little bit later on about cap rates, but ultimately, you're going to be looking at mostly properties that are based on per unit, per dollar per square foot numbers for land, dollar per square foot numbers for improved property, dollar per square foot values per unit. Those are the kinds of metrics that you're going to be using. You may get into this. The problem is there's not a whole lot to compare it to. I mean, how many of you guys look in the MLS on commercial properties and they show a cap rate, and if they do, how believable is it? Once you try and dig in and find out what the heck it's really based on, it's usually just based on somebody's wish or dream about what it would be, right? So this is just a formula here, an example here which shows you how you would determine a cap rate for this particular property. So it's just the NOI, so you got to get to NOI, right? Net operating income, to be able to determine what the cap rate is. Return on investment, that's what a buyer is going to really think about doing is what is their return on their cash investment. There's cash on cash returns that buyers are going to look at. Sometimes, again, most of the time you're going to be dealing with mom and pops who are just looking at, these are users, these are owner-occupied properties, and they're just looking at what the difference is for them between renting and owning, and they're going to put a lot of value on owning because then they can control their destiny versus leasing. And so a lot of times the formulas don't even apply to them. It's pride of ownership is going to outweigh a lot of the other parts of owning commercial real estate. It still has to make some sense for them. EBITDA is another, that's just a calculation at the top there for an example for ROI. And again, these are in your books. You're going to hear terms like EBITDA or cash flow or free cash flow, lots of different ways of expressing, but EBITDA is earnings before interest, taxes, depreciation, and amortization. That's one way of valuing a property is based. So you'll hear lots of times properties characterized as multiples of EBITDA, 3, 4, or 5 times EBITDA. The rules of thumb that you hear lots of times typically don't apply, because how do you get to EBITDA? You got to have a lot of good quality information, financial information that's been scrubbed. And most owners that you're going to deal with don't have that information to begin with. So you look at tax returns, and they're not even going to necessarily reflect the true situation, because again, owners are trying to pile up their expenses to reduce their taxable income, right? Business opportunities, whole different world of, and sellers mix the two. You guys will, so there is a difference between the value in a business, because the value of commercial real estate is all based on tangible assets, right? So if you're selling a commercial building, the value of that asset is the value of the land and the value of the structure, right? So you're going to add those together and you're going to come up with a value of that physical asset. When you get into business valuation, you start to talk about things like intangible assets, which can oftentimes be more valuable than all the tangible assets put together. So there are lots of different formulas for business valuation. There are comparable sales. Very hard to get around here. There's so few sales, and then you don't know the underlying basis of those comparisons. Discounted cash flow, that's, these get to be somewhat complicated calculations to make, and again, you have to have good basic information. You're going to see some of this stuff. Some of you guys may have been involved in the sale of businesses, and they go out and get a business valuation. I've done it many times, and to be very honest with you, it's hard for me to make heads or tails of anything that those business appraisers come up with. What does make sense, then there's asset valuation where you value the assets just like you do in a commercial transaction, and then there's again, the tangible assets and the intangible assets associated with an asset valuation. This is the one that I think you guys need to understand and probably focus on here, which is the justification for purchase test or the debt paying ability method. And this is what makes sense to me in terms of valuing a business, is what cash flow does that business throw off? What debt service can that cash flow support? So first of all, you're in most business transactions where you're selling a business either as part of real estate or not, the buyer is going to put down a down payment and he's going to finance the balance either with a third-party lender or the seller, right? So the transaction has to make sense. The buyer has got to get some return on that cash down payment, and then there's got to be enough cash flow to be able to service that loan, whether it's a third-party loan or a seller financed property, right? And then, if the guy's operating the business, maybe there's something left over for him as a salary, right? So, lots of times when you look at these transactions and you break them down on this basis, they would make more sense to you. Can somebody afford to buy this business, and can the business essentially pay for itself on some level? Again, if you get involved in this, this is the method that I think you guys can relate to. I think anybody can do this without having a lot of real detailed financial information. You can get down to a cash flow number on a monthly basis, and you can determine what that business can support in terms of debt. And that's going to largely determine the value of that business, irrespective of whether those assets are tangible or intangible or what they are. Does anybody have any questions about anything we've talked about so far? Please don't be shy. There are some of you who know more, like Paul, about commercial real estate in this room than I do. But here I wanted to show you some of the things that are available to you right now in dotloop in terms of form templates, so that you know that they're available to you right now to be able to use. So letter of intent. Sometimes in commercial transactions, you will start with a letter of intent or an LOI, which will allow the buyer and the seller to come to terms on the business part of this transaction. If many of you guys have been involved in larger commercial transactions, oftentimes the buyer and or the seller have a very different contract form that they're going to want to use. Their attorneys are not going to be happy with the FAR, the FAR commercial contract, so they're going to want to use their own commercial contract. You're going to have attorneys involved in lots of commercial transactions, more so than you will in residential contracts. That's not a bad thing. It's a good thing as long as you have good attorneys on both sides, and we have lots of good attorneys in the Keys who are very familiar with commercial transactions. You got Greg Oropeza, you got Bart Smith, you got Brian Hawks, you got Tom Wright, you got John Wolf, you've got in the Upper Keys, you got Pat Gessel, you got people all up and down the Keys who are good to work with on commercial transactions. So don't hesitate. Sometimes you're going to do an LOI. That LOI is then going to go to the party's attorneys. They're going to draft a contract. That doesn't mean that you haven't done your job. It just means that those attorneys are going to take over, because some of these transactions are relatively complicated. Sometimes in a commercial transaction, you're going to be selling land, building, and entitlements. You're going to be, you get into areas that you don't deal with traditionally in residential sales transactions. So there's a provision in this letter of intent that says that the parties have to enter into a sales contract within a certain period of time, or else this letter of intent essentially goes away. So there's no long-term binding interest between the parties here unless they move to the next level. That's an important consideration. Here's the commercial contract, which I'm not going to spend any time with today. Tom is going to go through this with you in detail. You will see that lots of folks, how many of you guys have used the commercial contract or it's been given to you? Okay. So there are some significant differences between this contract and the residential FAR bar contract. I would tell you that if I had a buyer, I would use the FAR bar residential contract over this contract, because if I was a seller, I would not want to, if I was representing a seller, I would not want to use the FAR bar as is residential. If I was a seller, I'd want to use this form if I'm representing a seller. But if I'm representing a buyer, I would probably defer to the FAR bar as is residential, because it protects the buyer to a greater extent. There's some warranties that the seller provides in the as is residential contract that the seller does not provide in this contract. Tom will go over some of the substantive differences with you between this commercial contract and the FAR bar residential contract, so you can understand those differences. There is a options clause addendum as well, which adds a number of things to this commercial contract, including 1031s, property inspection repair provisions, seller representations which you can add, warranties which you can add, which essentially make it more like the FAR bar as is residential, coastal construction control line, which we don't have to deal with. But some of these provisions are good. There's a buyer attorney approval and a seller attorney approval built into this, which if you're involved in a more complex commercial transaction, you may want to have in there to make sure that the buyer or the seller's attorney has looked at this, spreads the liability a little bit for you. Confidentiality agreement. So when you're involved in a commercial transaction, there's typically a lot of sensitive and commercial and confidential information that the seller is going to share with the buyer, and the buyer may even share with the seller, including personal financial information on the business. So most of the time you're going to want to use a confidentiality agreement, which is going to make sure that, to the extent that you can, that information is retained confidentially, that it is not shared, and that if the transaction does not for some reason go forward, that the buyer and or the seller can't continue to use that information against or share it with anybody else. So you're going to always want to, so you may want to do this when you share a package. So if you create a commercial package on a commercial property and you're going to share sensitive information, you're going to typically have a basic package that you send to someone, and if they want more information, they're going to have to sign one of these to be able to get the additional information, including the tax returns and the P&Ls and all the other things that go with that commercial transaction. This confidentiality agreement is meant to be signed not by the broker, it's actually by the buyer. So if you're dealing with a cooperative broker, you do not want that cooperative broker signing that agreement. You want the actual buyer, because the only person that's bound by this is the person who signs it. So you don't want the agent signing it, because then A, you don't know who their buyer is, and B, that buyer is not bound by it. Anybody have any questions about any of that? Yep.
Yeah, you can have both sides.
You can have both sign it, sure. The more the better. Absolutely. Commission agreements, sometimes in commercial transactions, you're not going to be able to get a listing. Sometimes sellers are going to be reticent about signing a listing agreement. Sometimes they'll sign a listing agreement that excludes it from the MLS, which is another way to go. But the more detail you can provide, this is the same essentially commission agreement as we have on the residential side. And it does have the provision in it that we can sue for our commission if the seller tries to defraud you. So in commercial transactions, there is a commercial lien act for commissions, now that we're talking about that in Florida. So in a commercial transaction, there's an automatic lien right that we have as brokers, but that lien right is only against the net proceeds that the seller receives. It's not for your full commission. So if the net proceeds are less than your commission, you're not going to get your full commission using just the commercial lien right that exists in Florida statutes. So our commission agreement, our listing agreement adds our lien rights to the commercial lien rights. They're separate in Florida, just so you guys know, okay? The contract talks about, the sales contract, the commercial sales contract talks about the commercial lien rights. And I don't know exactly where it is, but it's in here. But the commercial lien rights, just so you know, are different than our lien rights. Our lien rights are for your full commission, irrespective of net proceeds. Exclusive right of sale listing agreement for commercial property, both real and personal. Lots of times there's a significant amount of personal property associated with commercial transactions. So if you're selling a property, a business that has lots of inventory, you're going to want to try and get paid on that inventory because you're going to negotiate a sale that typically includes the sale of that inventory. Lots of times there's lots of equipment associated with commercial properties, and you're going to want to make sure you get paid for that because you're going to negotiate a sale for all that commercial equipment in addition to the real property. So when you get down to the commission here, you're going to see that there are specific numbers right in there in the number 2 under compensation of broker. So it says 15%, or excuse me, can't read it from here. What's it say? Sales price of the personal property, 15%, 10% of the sale of the property, and 10% of the gross rent. So it provides for the potential that you are going to do a lease option, which sometimes happens in a commercial transaction. So you have the right under the standard agreement here to get paid for both a lease that would predate a closing and a lease option contract, and you're going to get paid for the furniture, fixtures, equipment, and inventory or goods for resale, as long as you don't wipe those all out. If you're just dealing with commercial land and building or land and entitlements, you can just scratch those, but in most businesses you're going to want to make sure that you retain your rights to get a commission on the inventory for resale, the furniture, fixtures, and equipment, because it's integral to the business. The business can't operate without all that stuff, right? And you're going to want to make sure that if your deal includes a lease option, that you have a built-in right to get a commission on that lease option in addition to the sale, because that lease option may not end up in a sale. So you've done a lot of work, you get a lease, you get the buyer in there, and then they never option the property. You did a lot of work and you didn't get paid anything. It's not fair to you. It's not right, right? Yep.
What would be the strategy or reason to keep it out of the MLS, not to alarm employees, that type of thing?
Lots of sellers that you're going to deal with are going to be very, very, very concerned about employees. I have a significant business for sale in Key West right now that most of you don't know about. Its price is $14 million. It's a business that all of you know. And it's very hard for me because they're just absolutely apoplectic about having their employees know about this thing. They are just scared to death. And you can understand that. And they're concerned about their customers. So, a lot of commercial properties, businesses, you're not going to see a sign out in front. They're A, not going to want a sign. B, they're not going to want it in the MLS. So it does handcuff you in terms of your ability to market it. They're not going to want to see it in the MLS. but you could potentially put it on LoopNet and CoStar, which would not make it readily available to most of the agents in the Keys, but to other brokers in other areas it would become available to. So it's a good question, Rick. Anybody else have any questions? So in a commercial transaction, uniquely, there's 4 types of representation that we can undertake as realtors, right? We can be non-representative agents. To be a non-representative agent, you have to have the party sign a document that says you don't represent them, because if you don't have anything signed, the law is going to say that you are a transaction broker. You can represent buyers and sellers as transaction brokers, as we all know, which is what most agents do. You can represent buyers and sellers as single agents, and uniquely in a commercial transaction, you can represent buyers and sellers as designated agents, which is a form of dual agency, but the buyer and the seller have to meet certain financial requirements. They have to be qualified financially, but that would apply to most of the people that you're dealing with. So understand that there is a provision in Florida law for disclosed, essentially, dual agency in commercial transactions only. It's called designated agency. Marketing addendum, which goes with the, so as we all know, there are 4 parts to every listing agreement that we have, right? There's the listing agreement, the marketing addendum, the seller services guarantee, and the seller and the seller's disclosure statement. So all those documents exist for residential, for LIP, and for commercial. So they all are referenced in the listing agreement, so you need to get all of them signed, or else you don't really have a complete listing agreement. The terms and conditions associated with each one of these agreements are a little bit different, depending on the type of, so, you know, you'll see that this is quite a bit shorter than the marketing addendum for residential, because the issues are typically different. Seller disclosure statement, and I don't think I forgot to put in a commercial seller services guarantee, but it does exist, okay? So commercial leases, that's the other part of commercial business that you guys are going to be exposed to from time to time, whether it's a direct lease or whether it's part of a sale. It's a lease as part of a sale. So just so you guys are, again, familiar with some of these terms, I wanted just to expose you to them. I'm sure you've heard of them, and the more you get involved in commercial transactions, the more you will be exposed to these. So commercial leases are typically done with an LOI, or a letter of intent. That's your involvement. While you can fill out a commercial contract, you cannot, there is no state approved commercial lease form like there is on the residential side. So as you guys know, residentially, there is the Supreme Court of Florida approved residential lease for single family apartments, condos, and duplexes, and you can fill those out. Your license allows you to do that. Your real estate license does not allow you to draft a commercial lease or to fill out a commercial lease form. That's the unlicensed practice of law. You do not want to be getting involved in that. Commercial leases have tremendous amount of detail to them, and there's lots of implications associated with commercial leasing, and you guys need to really turn over the lease to the buyer and the seller so that they can either do that themselves or to their attorneys, which is more common. But you need to provide whoever the drafter of that lease is with the basic business terms of that lease. And that's typically as far as you're going to go in terms of negotiating a commercial lease. So there are single net, double net, triple net and gross leases. You guys have probably heard all of those terms. So there's two categories really, gross leases and net leases. Gross leases are where the tenant pays rent every month and the taxes and insurance and maintenance are included in that. Net leases, single, double, or triple net leases, the tenant pays rent, and then in addition to rent pays the taxes, insurance, and or maintenance, depending on whether it's a single, double, or triple net lease. There's also such thing as ground leases, which you guys probably will never see. They're wonderful things. I love them. I have a couple of them. And that is where, that is essentially the greatest form of triple net lease that you'd ever see for a landlord. But we won't talk about that here. So again, a triple net lease is where the tenant pays the rent monthly, typically, pays in addition to that, based on the lease, the taxes, the real estate property taxes, the maintenance, and prorated insurance on the property, right? And so in addition, commercial leases are subject to sales tax uniquely in Florida. Most states do not impose sales tax on leases. Florida does not, as you guys know. One of the attractions of people moving to Florida is there's no state income tax, individual income tax. So Florida lives essentially, the state lives on state sales tax revenues, and dock stamps on deeds is a big form of revenue. So so in a triple net lease, the amount of those taxes, insurance, and maintenance will be, maintenance is generally talked about in terms of CAM, common area maintenance, in a situation where it's there's multiple tenants in a building. They're all prorated typically, and they change every year depending on what the whether those expenses go up or down. Sometimes they are capped with cost of living, so that so there's tax stops, there's maintenance stops, there's insurance stops. It can get very complicated depending on how sophisticated the parties are, how big a lease you got. But you know, if you're doing a lease with Walgreens, and I've done 3 or 4 of them, I mean, you're dealing with a 40, 50-page document that has all kinds of legal provisions in it. I just finished one with CBP, with GSA. You guys do not want to get involved with doing government leases with GSA. You got to have a degree in this stuff. I mean, it's mind-numbing stuff. But it's if you do get involved in that, let me know, because I just got a re-education. I've done 3 or 4 of those too. So anybody have any questions about gross leases, triple net leases? So sales tax on commercial leases. So there has the Florida Association of Realtors, as I'm sure Lisa and Caitlin can especially tell you, being the past president, incoming president, the Florida Association of Realtors has been after the state legislature for the past few years to try and reduce or do away with with sales tax on commercial leases, because most states don't impose it. So it is viewed by many to be something that is not friendly to business. So as a result of this, they did reduce sales tax by 0.3% for commercial leases. So the state tax on commercial leases is now 5.7%, not 6%. Monroe County charges a 1.5% local option tax. That's for schools, and 1/2% I think is for schools. I can't remember how it all breaks down, but those are local option taxes. Those stay within the county. So sales tax on leases is 7.2%. That tax is imposed on the rent and on the pass-throughs. So pass-throughs are those expenses for taxes, insurance, and maintenance that are passed through to the tenant, and that's sometimes done on a monthly basis, sometimes done on an annual basis. Depends on the lease itself as to how it transfers from the seller to the buyer. But that sales tax is due on any money that goes from the buyer or the tenant or the lessee to the lessor. Okay. So here are the commercial leasing forms that are available to you in .loop templates. First is a letter of intent, which is again similar to the letter of intent for a sale, but this is for a lease, and this is where you're typically going to stop in terms of formulating a lease document. You're going to give this to the buyer and the seller, or the landlord and the tenant, and they're going to get their attorneys involved. And you're just going to outline the business terms of that lease. Exclusive commercial right to lease listing agreement. So you can't put commercial leases in the MLS now. So you would need this document to be able to put that in the MLS if you're doing a lease. So this is the commercial presentation that is updated for you. It exists where, Ruth, is IQ? Yeah. So that is the Coldwell Banker commercial logo. We are the affiliate. That's all available to you we pay for that by trademark. CBCworldwide.com is the Coldwell Banker commercial website. So this is a little overview, just like in the residential listing agreement or presentation about Coldwell Banker Commercial. And again, Coldwell Banker was really started as a commercial company in San Francisco in 1906. Talks about, so there's 144 companies in 44 countries and over 3,000 commercial agents. Coldwell Banker has more CCIMs. You probably are going to hear that term. CCIM is, what's that acronym stand for, Paul?
Certified Commercial Investment.
There you go. So it's not an easy designation to get. There's only a couple CCIMs in the Keys. It takes probably a year or two to get one. You have to travel around and go to a number of seminars, and you have to do a case study. You have to have meet certain qualifications to get the CCIM designation. So these are sales transactions for 2018. So this is the most recent information from Coldwell Banker Commercial relative to the number and volume of transactions that they were involved with last year by type. Leases by type last year. These are the Florida Coldwell Banker commercial brokers. So there's a NRT office in Boca, Coldwell Banker Parish in Gainesville. Jacksonville is Coldwell Banker Benchmark. Lakeland, Coldwell Banker, that's an NRT office. Miami's Commercial Advisors. In Naples, it's an NRT. Ocala, that's an affiliate, that's Ellison. And then down here in the Keys, over on the right-hand side, you can see all of our offices are listed as commercial offices from Key Largo to Key West. This is the U.S. coverage map for commercial offices, including in Hawaii and Alaska. So if you do have a commercial transaction that you want to refer, a buyer or a seller, there is a good network of Coldwell Banker commercial agents across the country that you can work with. And internationally, there are Coldwell Banker commercial offices in all those countries. These are some of the third-party agreements that Coldwell Banker Commercial has with various brands that you guys clearly recognize. and we've done business with a lot of those folks up and down the Keys. So this is some information about our company, obviously. So we go from the information about CBC in America and worldwide to us. And these are the demographics for last year for Monroe County. A little bit more about us. Our Everyday Until It's Sold marketing program, which applies to commercial real estate. It will go on our website as commercial real estate. It will go on CBC worldwide. And if you have a subscription to CoStar and LoopNet, it will go on there as well. So we do a commercial newsletter also, which will be, I think the next one is coming out here at the end of the year. So that will highlight all the year's commercial transactions and break down some of those numbers in terms of dollars per unit, dollars per square foot for land, buildings, and those kinds of things. Give everybody some gross metrics about the commercial real estate business in the Keys. This is what CBC worldwide looks like. That's what LoopNet looks like. That's what CoStar looks like. Other elements of our, including our newsletter, our unique, our signage. So all of this is available to you. It is meant to be personalized by you for your transaction. So these are sales comps that you may have, lease comps that you may have, recommendations that you may want to put in there, your plan to list and sell that property, your services after the sale. These are the updated most recent commercial transactions that we've been involved with as a company. They're already in there. It includes your Sean in there. I know we have 3 or 4 pending right now, which will be added in there as well. But Laurel Avenue, that was a redevelopment. 4900, that's a redevelopment. Northside Drive, that's Sean, that's the old Citizen building. 68250 Overseas Highway, that was transient, that was an operating property. 4800 Overseas Highway, that was a redevelopment property. 8220, that was the Sunset Inn. Fleming Street, that was the Artist House, that's yours, I think, Jeanette, right? Town Square Mall, on and on and on. So there are some commercial transactions that some larger ones that you guys have been involved with. You can update this with and personalize this with your own bio so that it speaks about you at the end here. So it goes from Coldwell Banker to Coldwell Banker Schmitt to you. It steps down in your client reference list that you're going to want to fill out and make sure highlights you. So that is the introduction to today's event. No, starts with the contract. So the letter of intent in both for a sale or a lease has a specific provision, and then there's an election in there as to how many days the parties are provided to enter into either a sales contract or a full lease. So the lease, obviously, and once you get into lease, there's going to be commencement date of the lease, commencement date of rent, a rent commencement. There's going to be different commencement dates in terms of a lease. Leases don't typically have an effective date, so to speak, like a sales contract does. But it'll be provided for in the sales contract or the lease. But those letters of intent are time sensitive. They are, if the parties do not go to the next level, which is having a sales contract agreed to or a lease agreed to, they die. Questions? Any other questions? Yes, Jimmy.
I got that commercial property on Summerlin. When we
Yep.
did the MLS and I put it on CoStar, does our company pick it up, put it on the site?
Yeah, it gets picked up in Dash, and Lynn will talk to you about how that is processed through Dash, which is their back of the house system to be spread out and sent out. Yeah. Yes, anybody else? Okay.
Third-party agreements, what does that mean?
Third party agreements, so Sam, it's a good question. So there are lots of, so these big companies, so you could do this, for instance, you could generate a third, so if you had, let's say you sold let's say Key West Boats, who you sold a house to, you could say, hey, I would like to talk to you about developing a national relationship with you and your company so that Coldwell Banker would handle all of your transactions on a national basis. So that national, it's essentially an agreement where all the business, whether it's leasing or sales, anywhere in the country, would go through a Coldwell Banker agent, and you'd get paid for every one of those. So some of those third-party agreements are very lucrative for the agent who established them originally with a big brand. They can be very valuable. Yep.
If we were to handle say a commercial property for a client and we were going to do the property management and a third party did the lease, how do we tie in Coldwell Banker with the leases written up by the attorney so we're getting the monthly income or leasing?
Yeah, so in a leasing situation, Rick, there's different ways to be involved. You can manage the property on a daily, weekly, monthly basis, collect the rents, distribute the rents, or you can be paid a fee for negotiating that lease. Most of the time, so for instance, Rick and Karen had the properties up in Islamorada. They both had them for sale and they managed the rentals. So they managed that property. They took care of all the common area maintenance. We paid the monthly mortgage payments, the insurance payments. We managed that property. There were, 14 or 15 tenants, so we managed every one of those leases. We got paid a leasing fee for leasing a unit. We got paid a fee for renewal of every one of those leases. And we got paid a monthly rent or a monthly fee for managing each one of those leases on a monthly basis. So in that case, we had an exclusive right of lease agreement and an exclusive right of sale agreement. And that would specify how you're going to get paid and what level of involvement you're going to have. It probably would require an additional document beyond just the exclusive right to lease document to specify, what your duties and responsibilities are, how you're going to get paid, and what you're going to get paid. So, what should you get paid for initiating a lease? So, typically, and Paul can chime in on this, who's been involved in lots of commercial transaction, either Paul actually, but we have Paul Rogers and Paul Tahara here. So, in a significant commercial leasing transaction, you'll be lucky to probably get, last big lease I did was Walgreens ground lease, $40,000 a month is what they're paying me for the dirt. How about that? $40,000 a month. So so the broker brought me Walgreens. I had to pay him $600,000 commission for that lease. But for $40,000 a month, I was pretty happy to do that. Pretty happy to do that. So obviously what you can get paid is a function of what that lease looks like and who that tenant is. So I could go sell that ground lease any day of the week for $7-8 million probably. People trade ground leases, I mean, they're like, you know, they're gold. They don't, none of these guys, Starbucks, Walgreens, CBS, none of them like to do ground leases anymore, because they're just not in their best interest usually. But what should you guys get for a typical lease? I mean, you should be getting, you know, 5 to 8% of the value of that lease minimally. It's a lot of work. And how you get paid is the other portion. So typically the landlord's not going to want to pay you when you sign the lease because he doesn't have any money. Rent commencement is usually not coincident with lease commencement. So you're going to get paid some portion of your fee at lease signing, some portion of your fee when they start at rent commencement, and probably the balance of it over some period of time during the term of that lease, so that landlord doesn't have to write you a big check, because that tenant could bail out in 6 months or a year, and they paid you a big fee and they have nothing, right? Here, the value of a lease with a mom and pop is like zero, in my view. Mom and pops can go any day of the week. There's, you know, the recourse for a landlord to go after a mom and pop tenant is pretty minimal. You know, you sue them, you get a judgment. What are you going to collect? It's any other. What's your experience in terms of leasing fees, Paul? And how have you?
Yeah, I mean, you know, typically, say a retail lease or something, we'd see maybe 7 or 8% of the term of the lease, and then maybe 3% of the renewal.
Yeah. Yeah. So I would. You should ask for 8% of the value of that lease. So if you write a 10-year lease at $3,000 a month, that's $36,000 a year times 10 years. That's $360,000 times 8%. That's what you should get paid. How you get paid is the next question. You're typically not going to get it all at once. And then if you enter into an agreement where you're going to manage the property, that management agreement is typically separate. It's going to be a percentage of the gross income on a monthly basis, and it's going to depend on how, you know, whether you oversee maintenance, how many of the bills you pay for them. I mean, in that property in Islamorada that we have, I mean, that owner lives in Spain. So we do everything. They don't know what the hell is going on. And as long as they get their check every month, they don't really care, right? And we've been managing that property for 5 years or more. It's been a great deal for Rick, and we do all the accounting. So we provide all the accounting through our accounting office, just like we do for all our vacation rentals. So it depends on what you're going to get involved with. You need to talk to me about that, because if you're going to get involved in one of those situations, because obviously there's a lot of that responsibility falls to the brokerage in terms of managing that property. Anybody else have any questions? Yes?
Brian, Shirley, is there a plan, is it common for the EMD to go hard in a commercial transaction?
For the what?
The earnest money deposit to go hard after a certain period of time?
Yeah. There is usually, and lots of times there'll be steps in those. So there'll be a feasibility study period, and usually a part or all of the deposit is going to go hard. Then the closing may still be subject to additional considerations in that contract, and so the only thing that's really at risk is the deposit by virtue of the contract. There's no provision for specific performance. So it depends on the deal, how complicated it is, but that's very common that a seller is going to want some real hard commitment from a buyer. Not unusual at all.